Hey everyone, and welcome back to the channel. Artificial intelligence isn't just the future, it's happening right now and it's reshaping entire industries. If you're looking to get your portfolio in on the action, you've come to the right place. In this video, we're breaking down the best AI stocks to buy right now. We're not just listing names, we're diving deep into the companies that are truly leading the charge, from the chip makers powering the AI revolution to the software giants integrating it into every product. Plus, we'll be sharing what top Wall Street analysts are saying about their growth potential and price targets. Let's get into it. Intuitive Surgical Inc., ticker ISRG. Intuitive Surgical is a pioneering American corporation and the global leader in the field of robotic-assisted, minimally invasive surgery. The company's core product is the Da Vinci Surgical System, an advanced robotic platform that enables surgeons to perform complex operations with enhanced vision, precision, and control through tiny incisions. By translating a surgeon's hand movements into smaller, precise movements of tiny instruments inside the body, the system facilitates procedures with potential benefits such as less pain, reduced blood loss, and faster recovery times for patients compared to traditional open surgery. While its technology is prominently used in urological and gynecological procedures, its applications span across general, cardiothoracic, and other surgical specialties. Intuitive's business model is built not only on the sale of these high-capital systems, but also on a significant recurring revenue stream from the accompanying instruments, accessories, and service contracts required for each procedure, creating a durable and integrated ecosystem. Let's start with what makes Intuitive Surgical so compelling. This isn't just a tech story, it's a story of a company with a deep and widening moat. First, the installed base. Intuitive has over 11,000 Da Vinci systems placed in hospitals worldwide. This is critical because it creates a classic razor and blade model. Once a hospital buys the multi-million-dollar system, they're locked into buying Intuitive's proprietary instruments and accessories for every procedure. This drives recurring revenue and creates incredibly sticky customer relationships. Financially, the company is firing on all cylinders. Their latest Q3 2025 revenue hit $2.5 billion, up 23% year over year. This growth isn't coming from nowhere. It's driven by a consistent increase in procedure volume. More surgeons are being trained, and more types of surgeries, from urology to gynecology to general surgery, are being performed robotically.
They're also highly profitable, with a net income of nearly $2.75 billion and an EPS that recently surprised analysts by 13.5%. Financially, they are rock solid, with a current ratio near 5, meaning they have plenty of cash to weather any storms and invest in innovation. And that innovation is key. With new products like the Da Vinci 5 and the Ion Endoluminal system, they're not resting on their laurels. They're expanding into new surgical specialties and geographies, particularly in emerging markets that are modernizing their healthcare infrastructure. Now let's switch gears. No investment is without risk, and for Intuitive Surgical, the risks are very specific. The most significant threat is rising competition. Companies like Medtronic are developing their own robotic platforms, and they're hungry for a piece of this lucrative market. While Intuitive has a massive head start, competition can erode pricing power over time. And speaking of pricing, the high capital cost of the Da Vinci system is a barrier. Smaller hospitals and clinics in cost-sensitive markets simply can't afford the upfront investment, which could limit growth in some segments. We also have to talk about geopolitical and regulatory risks. Policy changes in massive markets like China or Japan could disrupt growth plans. Furthermore, U.S. tariffs and trade tensions could make their international sales more expensive and less competitive. Finally, investors are keeping a close eye on profitability. While still strong, gross margins have slipped slightly to around 67–68%. If this trend continues due to competitive pressure or higher costs, it could concern the market, which is paying a premium for this company's exceptional growth. The consensus for Intuitive Surgical, ticker ISRG, is overwhelmingly positive. The current rating from most Wall Street firms is a resounding strong buy. The average 12-month price target from analysts sits right around $611. With the stock currently trading near $533, that represents a potential upside of almost 15%, and some firms are even more bullish, with one setting a high target of $685. So what's driving this optimism? Let's break it down. Major players like Morgan Stanley with a $650 target and William Blair with a $589 target point to a few key factors. First, strong financials. Their recent Q3 2025 earnings beat expectations, easing a lot of investor concerns. Second, procedural growth. More and more hospitals are using their robots for surgeries. This isn't just a one-time sale. It creates a recurring revenue stream from instruments and accessories. And third, innovation and expansion. Intuitive Surgical isn't resting on its laurels. They're continuously launching new products and expanding their global footprint, especially in international markets. Now, it's not all without some caution. There is a lower price target out there, around $440, which highlights that there can be short-term volatility. However, the overall vibe from the market is decidedly bullish. Technical indicators and the fundamental outlook both support a positive sentiment for the long haul. In fact, some long-term forecasts looking out to 2030 see the stock reaching as high as $900. So, to summarize, the analyst consensus for Intuitive Surgical is a confident buy. The confidence in ISRG's growth trajectory is high, driven by solid execution, increasing procedure volumes, and its relentless push into new markets. For investors looking at the booming med tech and AI-enabled surgery space, ISRG is widely viewed as a compelling opportunity.
Broadcom Inc., ticker AVGO. Broadcom is a global technology leader that designs, develops, and supplies a broad portfolio of semiconductor and infrastructure software solutions. Its business is segmented into two main pillars: semiconductor solutions, which include products like networking chips, storage adapters, and broadband components that power data centers, networking, and smartphones, and infrastructure software, which provides critical software for mainframes, cybersecurity, and enterprise automation. The company has grown significantly through strategic acquisitions, such as the landmark purchase of VMware, solidifying its position as a key enabler for the world's largest enterprises by providing the foundational technologies that drive modern IT infrastructure and complex digital environments. First, let's look at the numbers because they are staggering. Current price, around $368 per share. Market cap, a colossal $1.73 trillion. Recent growth, Q3 2025 revenue surged 22% year-over-year to $15.95 billion. Profitability, this is key. Broadcom is incredibly profitable. Its gross margin is a healthy 78.4%, and it generated a massive $7 billion in free cash flow in just one quarter. The big guidance. Perhaps the most exciting number is their Q4 forecast. They expect revenue of $17.4 billion. That's a 24% jump. So the financial engine is firing on all cylinders. But where is all this growth coming from? Here are the main drivers, the possibilities that have investors so excited. AI semiconductor dominance. Broadcom isn't just playing in the AI space. It's a core architect. They have a massive $10 billion custom chip deal with OpenAI. This isn't just a one-off. It signals they are a go-to for powerful custom AI chips known as ASICs. Diversified powerhouse. Beyond AI chips, they're a leader in enterprise networking, storage, and thanks to the VMware acquisition, they have a huge and growing software division. This diversification is a major strength. Shareholder rewards. All that cash flow funds consistent dividend payments, making it attractive for income-focused investors as well.
But it's not all smooth sailing. We have to talk about the challenges and risks. The valuation question. The most obvious red flag is the PE ratio of about 94. That is high. It means investors are pricing in perfection. Any stumble in growth could cause the stock to fall sharply. Non-AI weakness. While AI is booming, some of their other segments, like legacy networking and storage, are seeing some pressure. Fierce competition. They're competing directly with giants like Nvidia and others who are also pouring billions into AI. Geopolitical and supply risks. Like any global chip company, they are exposed to potential supply chain disruptions and trade tensions. So, with these huge upsides and real risks, what are the experts saying? When it comes to Broadcom, the message from analysts is incredibly clear and overwhelmingly positive. Out of more than 34 analysts covering the stock, the vast majority rated a buy or strong buy. In fact, according to data from TipRanks, we're looking at 27 buy ratings and 3 strong buy ratings. And get this, there are virtually no sell ratings to be found, just a couple of holds. This kind of consensus doesn't happen by accident. It signals deep, widespread confidence in the company's direction and its financial health. Broadcom is a critical supplier to the world's biggest hyperscale cloud providers, companies like Google, Meta, and Amazon. As these giants race to build out their AI capabilities, they need advanced networking chips and custom AI accelerators. That's exactly where Broadcom shines. Jefferies recently raised its price target for Broadcom to a street high of $480 per share. They cited accelerating demand from hyperscale cloud providers and AI workloads as the key driver, seeing a potential 32% upside from recent prices. Bank of America and JP Morgan have both highlighted Broadcom's prominent role in the AI semiconductor bull market, and the news of a massive $10 billion AI-related deal with OpenAI proves that Broadcom isn't just supplying parts, it's building the very backbone of the AI revolution. But the optimism isn't limited to just one or two firms. This is a broad-based confidence. Other major firms like Oppenheimer, UBS, and Morgan Stanley all maintain outperform or buy ratings, with price targets generally ranging between $340 and $400. Pulling all this data together, the average 12-month price target from analysts sits around $394. That represents a solid upside of roughly 7 to 8% from current levels. While that might seem modest, remember, this is for a massive established company, and it doesn't include the potential for even more explosive growth as AI spending continues to accelerate.
Amazon.com Inc., ticker AMZN. Amazon is a global technology and e-commerce leader, founded by Jeff Bezos in 1994, which has evolved from an online bookstore into a multifaceted behemoth operating through 3 primary segments. Its iconic North America and international e-commerce divisions, which sell a vast array of products directly and through third-party sellers, and the highly profitable Amazon Web Services, AWS, the world's leading cloud computing platform. The company's ecosystem is deeply integrated into the daily lives of consumers and businesses, encompassing digital streaming, Prime Video, smart devices, Alexa, Kindle, logistics and fulfillment networks, and a dominant subscription service in Amazon Prime, which fosters immense customer loyalty and recurring revenue. This diversified model, fueled by a relentless focus on customer obsession, innovation, and operational scale, has solidified Amazon's position as one of the most valuable and influential companies in the world. Amazon is not just growing, it's accelerating. In Q3 2025, revenue jumped 13% to over $180 billion, beating expectations. But the real story is its cloud division, AWS. After a period of slower growth, AWS revenue re-accelerated to over 20%, now on an annual run rate of $123 billion. This isn't happening by accident. Amazon is going all in on AI. They're building Project Rainier, an $11 billion AI data center, and baking artificial intelligence into everything from its retail recommendations and advertising to its Alexa devices. The bottom line is also improving. Operating income in North America is up 22%, and internationally it nearly tripled. So the core business is strong, and the growth engine of AWS is firing on all cylinders again, powered by AI. But this growth comes at a cost, and this is where investors get cautious. To win the AI arms race, Amazon is spending big. They've raised their 2025 capital expenditure guidance to a massive $11 to $12 billion.
This heavy investment is temporarily squeezing two key metrics. Free cash flow is down. AWS operating margins have dipped to around 33%.
So you have to ask, is this a smart long-term bet or a red flag? On top of that, the competition is fierce. Microsoft and Google are relentless in the cloud space. There's also ongoing regulatory scrutiny, economic uncertainty, and the constant need to balance this explosive growth with cost control, which we've seen through some workforce reductions. Here's the summary. Amazon is sacrificing near-term margins for long-term dominance. The pressure on cash flow and margins isn't a sign of a broken company, but of a company in a massive investment cycle. They're building the infrastructure to stay on top for the next decade. The sentiment on Amazon is overwhelmingly positive. Out of the 52 analysts covering the stock, a staggering 51 rated a buy, with another 3 giving it a strong buy. That's an almost unanimous vote of confidence. The consensus average price target sits at $291.94. That implies an estimated upside of nearly 20% from current levels. But as we'll see, some firms believe it can go even higher. So what's fueling this bullishness? It boils down to 3 key engines. First, and most importantly, AWS and AI. Amazon's cloud division AWS is re-accelerating growth, and a huge part of that is thanks to artificial intelligence. Companies are rushing to build and deploy AI models, and they need Amazon's massive cloud infrastructure to do it. This leads us to the upgrades. New Street Research is incredibly optimistic, raising its price target to a street high of $340 and calling Amazon a top pick. They cite expectations for strong AWS revenue acceleration and AI-driven growth. Similarly, Piper Sandler upgraded Amazon to overweight with a $300 price target after solid Q3 2025 results, pointing to the payoff from their heavy AI investments. But what do you think? Is Amazon a buy for your portfolio in 2025? Let me know in the comments below.